Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Yasmin Daya-Bilger, head of ETFs at Engine Number One. Engine Number One was a little-known activist investor firm that sent shockwaves through the market in May when they took down Exxon Mobil, winning 3 board seats. In June, they launched the Engine Number One Transform 500 ETF, ticker symbol VOTE. And we know that sustainable investing is one of the hottest trends in the market these days. But the VOTE ETF is actually quite different from other popular ESG ETFs. It is first of its kind. And most other ESG ETFs, they rank companies on environmental, social, and governance metrics. And companies that get a better score, they get a bigger weighting in the index. And companies that have a bad score or a low score, they are either excluded or they get a lower weighting. But the VOTE ETF actually intends to encourage transformational changes in companies through shareholder activism. And I'm very excited to talk about Engine Number One and the VOTE ETF with Yasmin. Yasmin, welcome. Thanks so much for joining us.
Thank you for having me.
So to start off, please tell us a little bit about Engine Number One. And I read that it was named after a fire station in San Francisco, which is a block away from the firm's office. So that's pretty interesting.
Yes, it's a nice visual, and it makes you think of sort of running into the fire versus running away from it, which I think is a nice analogy for who we are. So Engine Number One is an investment firm that's focused on tying environmental and social issues to economic outcomes. I mean, we were really founded on, I'd say, the shared belief that the investments that a company makes in its employees, in its customers, in the communities that it operates in, and in the environment are actually linked to its ability to drive long-term shareholder value. Or said differently and maybe more simply, a lot of the conversation on environmental and social issues feels a lot more about ideology. We're focused on the economic arguments associated with it. And we think there's a lot of reasons why that is the case, that this is materially linked to shareholder value. I mean, everything from government regulation to shifting consumer preferences to technological innovation. In terms of what sits across the firm, I'd say there's really 2 core pillars. The first is our focus on data. And this is really around thinking about the value of a company and thinking about, more specifically, the positive and negative externalities that a company has on environmental and social issues and how that's linked to its long-term shareholder value. That informs the investments we make and the engagements and the campaigns that we run. The second is, you use the word activist. We really see ourselves as active owners. And we almost have, in my mind, more of a private equity mindset towards our role as owners. And it's really about, for us, focus, doing the homework in terms of understanding the things we're putting forward. And for us, our toolkit is very wide when we think of active ownership. And I think that's a really important part of the breadth of the firm. I should say, since I run our ETF business, for me, the ETF business has a really important strategic role within the Engine Number One franchise. I mean, first and foremost, it's the place every investor can come along with what we're doing. And I think that's really important for who we are and what we're trying to build. Most investors have ETFs in their portfolios. So I think that that's a really profound avenue for us. The second is scale. I mean, as we all know, the ETF industry is large and growing very quickly. And so this is the part of the business where we think we can drive scale. And I think that has a huge implication for how we amplify our voice in market.
Very interesting. Now, I understand that you have been in the ETF industry for the past many years. So tell us a little bit about your background and how you got involved with Engine Number One.
Yeah, of course. So I've done a number of things in my career, but I guess most related to this role was the fact that I was one of the early employees in JP Morgan's ETF business. In fact, I joined that firm's ETF business when I think they had just one ETF in market and $25 million in assets. And so I had the opportunity to really be at the forefront of thinking about the product strategy of that business and how to go to market. In fact, when I left, I think the firm had just crossed $60 billion in assets. So it was quite a fun ride. But in addition to being fun, what it was also was a really interesting experience in thinking about how an asset manager enters the ETF industry. I think many people may already know, I mean, the ETF industry is large, but it's also very concentrated in the top providers in the space. And so it sort of begs the question, how do you actually enter and grow an ETF business? And so that was a really interesting and unique learning for me, and really informed one of the reasons I joined Engine Number One. First and foremost, I was really excited to go back to the beginning. I'm a builder, and I loved the idea of getting to start with sort of a blank page and really help define what we wanted to be in ETFs. But secondly, I thought there was so much potential for what Engine Number One was trying to build to bring that to the ETF market. First and foremost, I think one of our strengths and one of the things that attracted me to the firm is our focus. For many asset managers, impact is a small sliver of what they do. For us, and for the beliefs I started with, I mean, that is all we do. That is who we are. That is what we were founded upon. And so in most cases, I think size is a disadvantage in ETFs. It's a scale business. But in this case, I actually think the fact that we're purpose-built in this space was a huge and interesting advantage to me. And then secondly, I thought of the potential. And really for me, ETFs are, in some sense, the truest format of democratization for investing. Anybody with $25 or $50 can buy an ETF. And now with fractional shares, even less than that. And so the idea of being able to bring what was special in Engine Number One to the ETF industry and to that breadth of investors was really exciting as well.
Yeah, so you talked about your experiences with JP Morgan and asset managers entering the ETF business. And that makes a lot of sense because ETFs are the new hottest investing trends. But Engine Number One is not an asset manager. It's quite different from an asset manager. So why did Engine Number One decide to launch the boat ETF?
Yeah, I think this is a really unique idea in the ETF market. So maybe just taking a step back to talk about the sort of market opportunity, if you will. As all of us know, one of the most profound trends in the asset management industry for the last several decades has been this rapid growth and prolonged growth in low-cost market cap investing. I mean, virtually every investor has a low-cost market cap strategy in their portfolio. And I think for many reasons that growth happened, including the fact that it solved a very simple thing for investors. It's low-cost, diversified, simple exposure to the market. But I think many investors look at market cap strategies and think it's very commoditized, that they're all the same. And only now do I think that investors are really actually looking under the hood to understand a little bit more about how those assets are being used from a voting and engagement perspective. I mean, if you think about it a little bit more ideological, shareholders have a vote. A right to vote. In fact, every year there's something like 25,000 votes that come up at public companies in the U.S. And these aren't important issues: electing the board, executive pay. And when you're a shareholder, you have a vote and you have a voice. And that voice is very powerful. And so I think this is an area that that people are just really beginning to very much focus on now. Vote is launched in that context. I think it's tapping into that. It's tapping into the power of passive investing to drive the active ownership work that we're focused on. And so what that really means, practically speaking, if to share a bit about the fund, on the investing side, it's a market cap strategy. It tracks a market cap index that has exposure to the largest 500 companies. It's priced at 5 basis points, which is really in the zone of where most market cap strategies are priced today. So in effect, it's very similar to what many people have in their portfolios today on the investing side. Where it's very different, I would say, is the work we do on the active ownership side, which for us really means 3 things. Foundationally, it's the way we vote our shares. Secondly, it's the engagements and campaigns that we run. And then thirdly, it's the investors we bring along with us, both the people who invest in our strategies, but also the sort of academics and advocacy group partners that we can use to amplify our voice.
So as you mentioned, the index tracks the 500 largest companies in the US. The index is Morningstar US Large Cap Select Index. And I'm looking at the top holdings. It looks very much like the S&P 500 ETFs: Microsoft, Apple, Amazon, Google, Tesla, Facebook, and Nvidia. These are the largest holdings in the ETF. This is very cheap, just 5 basis points, as you mentioned. So for investors who are interested in comparing this ETF versus other S&P 500 ETFs, could you tell us how is this index different from the S&P 500?
Yeah, I mean, that is this I think the simplicity of this strategy. As you say, when you look at the holdings, it's very similar. And that was sort of really intentional on our part. So we track a Morningstar index that gives exposure to the largest 500 companies. There are some small methodology differences between Morningstar and the S&P 500. But in fact, if you look at sort of long-term numbers, those two indexes are very similar in nature. And so from an exposure perspective, it's quite similar to what investors have if they own the S&P 500, with some, as I mentioned, small methodology differences. Where I think the difference is, and where when we're talking to investors, most people are really focusing with us on, is that voting and engagement piece, which I think is really where things can seem very different. So maybe just to explain that a little bit more on the voting side. As I mentioned, this is a really important part of, I think, the landscape right now. What most investors don't know, and I think the statistic would actually surprise a lot of investors, is that if you looked at the average S&P 500 fund between 2015 and 2020, the average S&P 500 fund voted against almost 90% of environmental and social shareholder proposals. That's I think would probably be a very surprising statistic to most people. So our voting policy, we designed a custom voting policy, lends a higher degree of support to those types of proposals, more to the tune of, let's say, 65 to 85%, and really focused on greater transparency and accountability in those spaces. So I'd say that's sort of difference number one. And then difference number two, I think, is just our general philosophy towards engaging with companies. I think a lot of asset managers think about their engagement strategy more around quantity of engagements, and we're really focused more on deep, specific engagements with companies. And as you said, we had the Exxon Mobil campaign, which was obviously a very high-profile format of that. We also more recently announced an engagement with General Motors to support the work they're doing to electrify their vehicle fleet. So those types of engagements, but much more focused in nature.
Yeah, I looked at the performance since its launch. It has very closely tracked the S&P 500 index. Both are up about 11% since both's launch. Could you talk a little bit more about your strategy to force operational changes in portfolio companies? Because you mentioned the power of passive investing.
Yeah, I mean, I think this really goes back to the viewpoint that we see ourselves as active owners and take a mindset really that's oriented around that. What you look at most large asset managers, as I was just saying, they really do focus on quantity. And what I mean by that is trying to get around to all 500 companies in the portfolio, if it's the S&P 500, on many, many different issue areas. We have almost more of a private equity viewpoint towards it, which is narrow and focused. And so what we're really focused on is thinking about the areas, the key themes we want to focus on, the key companies where we think that change is, can be important and made, and very importantly, linking it to long-term shareholder value, which is sort of, as I said at the front of this, one of the pillars of what we do. And that really drives how we think about our overall engagement strategy with portfolio companies. So one of the questions we get all the time from investors is, gosh, you're a small firm. How are you going to get around and do engagements with all 500 companies in the portfolio that you have and vote? And the answer almost very definitively is that we will not be doing that. We take a much more narrow approach. And I think that approach is more focused on impact. To me, this is actually one of the things that I believe will be a big unlock for us in this space. I think most investors look at sustainable investing, and one of the challenges for them is it's not real. So what if it all is not very tangible? And for us, we have these stories that we can share with investors who are in our funds, whether we talk about the Exxon campaign or like General Motors. It helps to really bring to life the so what of what we're doing.
So we know that some of the biggest companies in the S&P 500 index, including Google parent Alphabet and Facebook, which is now Meta Platforms, they have dual class shares, which give super voting powers to certain shareholders, mainly their billionaire founders. And we have seen this trend in many recent tech IPOs as well. And obviously, this dual class voting limits the ability of most shareholders to push for changes. So, what are your thoughts on dual class shares? And is engine number one going to push for one share, one vote standard?
Well, maybe just to answer it more generically, I mean, for me, this goes back to first principles and sort of what we were talking about earlier, which, the power of the shareholder vote and a system built on accountability through that shareholder vote. So in many senses, the dual class shareholder structure gets in the way of that. It limits the ability for shareholders to do that. Now, there may be certain circumstances where it makes sense, for example, right after a company goes public, but generally from a corporate governance perspective, we think that the shareholder vote is a really important and powerful tool. And so I'd say that that's principally how we would orient on that topic.
So as you mentioned, and I also mentioned earlier, ESG investing is one of the hottest trends in the ETF industry and the investing world in general, and especially younger investors, including millennials, they want to support companies whose mission aligns with their values. So ESG ETFs have gathered a lot of inflows in this year and past few years. So for investors who are interested in this ETF, how should they look at VOTE versus other ESG ETFs?
So it's a very interesting question because when you look at the ETF landscape, you really see two types of strategies in market in the ESG space. The first is companies that exclude companies based on the sector they're in or a viewpoint that's trying to be expressed. The second are strategies, as you mentioned earlier, that reweight companies based on metrics that are associated on environmental and social issues. But for the most part, those two categories of products are really ESG by what they hold. I would say we're ESG by what we do, not what we hold. So, fundamentally, VOTE is based on the idea of we want to keep the investing side as similar as possible to what investors already own, its market cap. So the portfolio itself will not have that difference in portfolio from a large perspective versus what you see out in the ESG market. Now, why I think that's relevant for investors is twofold, because number one, as you were saying, the space is gathering a lot of assets, but I actually think there's still a lot holding investors back from ESG. First being performance. I think there is still a very high perception amongst investors that there's actually a trade-off here, and that in order to invest in quote unquote the space, they have to give something up on the financial performance side. And I think that the difference, a lot of ESG portfolios can create a lot of noise in performance. So for example, a lot of ESG strategies in market right now outperformed in 2020 because they had a higher degree of exposure to technology, underperformed in 2021 because of a lower exposure to energy. And that noise, I think, is actually one of the things holding people back. I do believe VOTE helps to solve that. The second in my mind is this, what we were talking about, what we call the theory of change, the so what of it, which is if you move your money into one of these funds, what's different about the world? What's the connection point to what the impact is? And I think VOTE, particularly with this focused approach to engagements, really helps to bring that to life investors, which is important because on an ongoing basis, I think investors want to be along for the story and what their assets are doing based on their views.
So with the rise in index investing, these fund giants, including BlackRock, Vanguard, and State Street, they have become huge forces with a lot of shareholder power at their disposal, and they have the ability to push for changes. And according to Bloomberg data, BlackRock, Vanguard, and State Street, the big three, they now hold 43% of the fund industry's US equity assets. And according to SEC, indexed mutual funds and ETFs now own 30% of equity in the US stock market. So that just shows their power. And you mentioned some historical data on their voting record. But we have seen that recently they have started pushing for better ESG standards. So what is wrong with the approach that these ETF giants are taking? And also, do you plan to work with them?
Well, maybe let's tackle that in two separate pieces. The first around voting, you're absolutely correct. We've seen a very significant trend, if you look at the industry, towards two things. One is more environmental and social shareholder proposals. I think this actually is reflective of sort of an excitement of investors in this space. And secondly, as you say, a higher degree of support for them. Although I think our policy would have us map even higher. But that to me really goes to us being sort of the tip of the spear on many topics. So number one, I think on the voting side, there's still a lot of degree of room for movement. But I also think on the engagement side, this is what I was saying about size being a strength of ours in some ways. This is what we're purpose-built to be and do. And our focus, I think, on individual companies and specific companies as opposed to sort of a more quantity approach to it, I think can help us actually drive real change. We certainly have to work with other, in public markets, you're only as successful as the investors you can bring along with you. In fact, the Exxon campaign is the perfect example of that. We would never have been able to accomplish what we accomplished without the support of all of the large holders in that company. And so absolutely the idea of bringing investors along with us is a critical part of what we need to get right.
Excellent. Now, I wanted to talk a little bit about the campaigns, and I read that Exxon was chosen as the first big campaign because a large number of other institutional shareholders were also angry about the oil giants' refusal to engage. And you alluded about GM, General Motors campaign too. Could you talk a little bit about how you decide which campaigns to pursue? And I'm not sure if you can talk about your future campaigns as well.
Yeah, without talking about anything in the future for us, I think both our approach with ExxonMobil and, as you say, our approach at General Motors is very reflective of the way we think about our engagements with companies, which is absolutely focused on the shareholder value argument. And this is what I was saying at the beginning when I was talking about what we believe in. We believe in the fact that there are critical environmental and social issues that are linked to long-term value. And doing that deep work and understanding from a data perspective what we think the quantified impact is of those footprints is very important to determining what we end up doing. So in the case of General Motors, as you say, that's in an industry that's undergoing transition. It has a very strong management team and board, and they've embraced the future. And that company took early steps to invest in the technology it needed to build a new platform and convert their entire production fleet to electric vehicles. And we think that company is best positioned to monetize those early investments. That is the type of thinking that we would use when we think about engagements with companies. But very importantly, it's really focused on the economic argument and the deep work around that. It sort of goes back to what I was saying around a focused approach, as opposed to, for example, with Vote, as I said, we have 500 companies in there. That's just not our strategy to go from a quantity perspective. It's much more about linking these issues to economic arguments. That's going to be very important as well to what we discussed, which is bringing other shareholders along with us and what we're trying to achieve.
So the ETF launched in late June, and it already has gathered almost 250 million in assets. So I would say that's a pretty successful launch. And that makes sense because it's a very interesting, very unique ETF. So I wanted to know if you plan to launch more ETFs in the near future.
Well, thank you. Yes, we've been really excited with the momentum of Vote and having launched a number of ETFs in my past life. I've been really excited about the investor reception and the scale we've been able to achieve thus far. Hopefully, it's just a drop in the bucket for us. We definitely built our platform for scale and for the long term. And so our one is to absolutely launch additional ETFs and really build a product set that we think reflects the strength of this firm and provides really unique solutions to investors in the market. So our next strategy that we're actually publicly filed for is a climate strategy. It's an active equity strategy, so more of a theme-based approach. And I think will very much reflect much of what we talked about today, which is our linkage towards the deep work we're doing here at this firm on linking environmental and social issues to shareholder value and what that means on the investments that you make from an active perspective. So that's next on the docket for us, and hopefully many other strategies that do reflect some of the viewpoints we have here that we talked about today.
Excellent stuff. Good luck with the new launches whenever they come, and congratulations on all the success. That's all we have time for today. Yasmin, thanks so much for joining us.
Thank you for having me.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.